Hi, welcome to Let's Talk Bonds, a weekly podcast from INR Bonds. I'm Arjun Patsati. And in this week podcast, I'm going to talk about where the GSEC yields have fallen and where should fixed income investors or financial advisors advising their clients on fixed income should tell them where to invest, should they invest. Uh, while the 10-year GSEC yield has fallen, uh, it's not however, if you look at the whole all the maturity segments of all the bonds, um, there is not too much of difference between the 1 year and the 10-year GSEC levels. And similarly, this the case is the same with corporate bonds as well and PSU bonds. So all this put together, now the question is the market is asking whether interest rates have peaked out. But if interest rates have peaked out, why is the 1 year and 10-year GSEC almost at the same rate? That means, and if you look at the interest rate derivative, which is the swap rates, the 5-year swap is at 6.1%, and the 1 year is at 6.7%. So this seems to be the 5-year swap is lower than the 1 year, which is normally not the case for any interest rate product. So let's talk about this. And maybe at the end of this podcast, you should get a definitive idea of where one should be investing if you're looking to invest for the fixed income. Before that, if you are a financial advisor, come to our partner portal, get all the benefits of the partner portal, from research to bonds to information to day prices, and the easiest of investment processes for your clients. And you can see your assets grow from end-to-end support with INR bonds, from pre-trade support to pre-investment support to post-investment support. The full range of products are available to you. So log into INR bonds partner portal and avail of the full benefits of INR bonds by empaneling with us. Empanelment forms can be obtained from our customer service and our relationship, guys. And if you're looking for curated list of bonds, download our app, Quick Invest by INR Bonds, where we curate bonds to make decisions easier. Again, with the best of information and price discovery, giving you the easiest of in-app investment processes. Download the app now, iOS and Android. Coming back to Let's Talk Bonds. Now, 10-year GSEC yields have fallen from 7.5% at its peak, maybe about 6 months ago, to 7%. And similarly, if you look at global yields as well, the US Treasury yields have fallen from over 4% to 3%, 3.3% kind of levels. But having said that, if you look at the 1 year, 2-year, 5-year, and other GSEC yields, they are all in a range of 6.7, 6.8% to 7%. 5-year GSEC yield is actually at 6.93%, over 6.9%. And in fact, the recent auction cutoff, the 7-year GSEC yield came over 7% levels, which is higher than the 10-year GSEC yield. So a lot of confusion for investors. Now, why should, if 10-year GSEC yield at 7%, do I invest in 10-year maturity bonds, or should I invest in 1-year or 2-year or 5-year maturity bonds? Clearly, intuitively, it sounds that I'm taking less risk by investing in lower maturity bonds. But having said that, after the sharp fall in 10-year GSEC yields, the capital gains for those who had invested at 7.5 has been pretty good. And if expectations are that it can go down to 6.5%, for example, then 10-year GSEC makes more sense than 5-year GSEC yields. Similarly, in the PSU bond space, Bharat Bond ETF at 2025 and 2032, they're all in the around, not too much of difference in yields. And in corporate bonds, again, you have a situation where you have these are PSU bonds are in a range of 7.3 to 7.4, 7.5% across the maturities. Corporate bonds, AAA bonds, you have 1 to 10 year bonds in a range of say 7.5 to 8% or 8.1%. And if you go down the rating curve, the yields are almost flat. In fact, many of the bonds that were trading are trading at almost similar levels they were trading at 2 years back. So clearly, what is happening here is that only the GSEC yields have come down, and the sharpest fall has been in the 10-year GSEC yield. So this is the current situation. So what is it? What is the market saying? Clearly, in with the if you really go by theory and where the 10-year GSEC yield is, the market is saying that given that long-term inflation will come down and RBI and the US Fed will start to cut rates, maybe starting next year or year after next. And that is why 10-year GSEC yields. And currently, to prevent inflation from overheating, and also the fact that central banks have seen too high inflation, they are a little worried that inflation will go back again. Hence, they're keeping rates at very high levels. They have been hiking rates, but they are not in a position to bring down rates soon. So all this put together is keeping the yield curve like this. So there's still a bit of uncertainty. Central banks are still worried. But having said that, if there is any threat to economy and inflation expectations are looking to come down, then what they will do is they will change their stance and put in money into the system as well as bring down rates, maybe not too low, but maybe to a normalized level. But even this can actually help bring down short-end yields. So the best place for investments, what we believe at this point of time, is anything of AAA bonds at 8%, and 8 to, if you can identify, and if you go down the rating curve, and want to willing to take a bit of moderate risk, 8 to 10% can be a range, largely in a 3 to 5 year kind of a bucket. And this should both protect investors from any uncertainty on inflation and rising long-term yields, and also earn them enough returns to for the fixed income investments to start to be working for them in their portfolio. So that is about it. And financial investors, advisors, and also investors can come into R&R bonds, find the best bonds to invest in, and take it and get the best investments going on fixed income. Thank you very much for listening in, and do follow us on all podcast channels.